What if I told you that you can buy a piece of the biggest companies in the world for the price of a lunch? Sounds suspicious, right? At its core, the stock market is just a place where people buy and sell tiny pieces of companies. That's it. No magic, no secret handshake. When you buy a stock, you're basically saying, hey, I want a small slice of this business. It could be a tech giant, a clothing brand, or even a company that sells, well, things you didn't even know existed. Imagine your friend starts a pizza business. You believe it will be huge, so you give them some money in exchange for a share of the business. If the pizza place becomes popular, your share becomes more valuable. If the business fails due to poor management or lack of customers, well, your share loses value. The stock market works exactly like that, just on a massive scale. Now, how do prices actually change? This is where it gets fun. Prices move based on supply and demand. If lots of people want to buy a stock, the price goes up. If more people want to sell it, the price goes down. It's like an auction that never ends, with millions of people shouting buy and sell at the same time, except it all happens digitally and much faster. But why do people suddenly want a stock more or less? Usually it comes down to expectations. If a company is doing well, making money, launching cool products, people think this will grow, and they buy. If the company messes up, loses money, or does something embarrassing, people panic and sell. Sometimes it's logical, and sometimes it's just pure emotion. Yes, the stock market can act like a very dramatic teenager. Here's another key idea. You don't make money unless you sell. If you buy a stock for $10 and it goes up to $20, you haven't actually made anything yet. It's just numbers on a screen. You only profit when you sell it for more than you paid. Until then, it's like owning a lottery ticket that keeps changing its value every second. Now let's talk about risk, because this is where people get nervous. Stocks can go up, but they can also go down. And sometimes they go down a lot. That's why smart investors don't put all their money into one company. Instead, they spread it across many different stocks. It's like not putting all your eggs in one basket. There's also something called long-term investing, which sounds boring, but it's actually the secret sauce. Instead of trying to guess what will happen tomorrow, people invest for years or even decades. Why? Because historically, the market tends to grow over time. Not in a straight line, of course. It goes up, down, sideways, but overall, it has a habit of climbing. And no, you don't need to be rich to start. The barrier to entry is lower than ever. The real challenge isn't money, it's patience and not freaking out when prices drop. So in the simplest terms possible, the stock market is a giant marketplace where people trade pieces of companies. Prices move based on what people believe will happen in the future, and money is made by buying low and selling high, ideally in that order. It's not magic. It's not reserved for experts. It's just people making decisions, sometimes smart, sometimes emotional, sometimes completely random. And once you see it that way, it becomes a lot less intimidating and maybe even a little bit exciting. Remember, investing in the stock market always involves risk, and you can lose all of your invested money.